The RBA held interest rates steady in June for the first time this year, after three consecutive increases from 3.85% in February all the way to 4.35%. The board paused unanimously. This is a shift, not a reversal. Inflation is still at 4%, and the target band is 2 to 3%. It is a signal that the board believes the tightening is working. In that environment, 5 New South Wales commercial properties transacted: a service station in Newcastle, a childcare centre in Hurstville, a half-floor office in the Sydney CBD, a freestanding building in Kingsgrove, and industrial property in Marrickville. Each one tells a different story. Together, they tell you something important: what buyers are actually paying for in 2026. I'm Contasitas, licensed commercial real estate agent and registered business broker in New South Wales, and this is the July 2026 edition of the Transition Edge. The first sale is a service station in Hamilton, Newcastle. Land area just under 1,500 square metres, building area 264 square metres, net income $321,368 per annum, sold for $5.691 million, representing a yield of approximately 5.6%. Now, why does a service station in Newcastle sell for that sort of money, $5.7 million? Because the lease runs to 2039, with options extending all the way through to 2074. The facility was upgraded 2 years ago, and the tenant is a credible established operator. That 5.6% yield is not about the building, it is about the income certainty behind the building. The lease is the asset. I'll come back to that theme in a moment because it is the most important thing I want to cover today. The second sale is a childcare centre in Hurstville, 626 square metres, leased to 2041. A further 2 10-year options running to 2061. Net income $97,507 per annum, sold for $2.67 million. At first glance, that looks like a yield of 3.6%, which seems extraordinarily low. But here is what you need to understand. The rent appears to be currently below market levels. An informed buyer has not priced this property on what it earns today. They have priced it on what it will earn once the rent is brought to the market, which under lease structure can happen in the next review. Below market rent on a long lease is not a weakness, it's an opportunity if you understand how the lease works. Third, a half-floor office in Market Street in Sydney CBD, 472 square metres, vacant possession, excellent condition, sold for $5.2 million. That tells you something about the flight to quality in this office market. Buyers and tenants are consolidating into better buildings, better fit-outs, better locations. Presentation is doing more work than ever. The fourth property is in Kingsgrove Road, Kingsgrove. Freestanding 2-storey building on 771 square metres, 2 street frontages, drive-through provision, 9 on-site car spaces, which are rare for that area, dual entrances allowing for 2 separate tenancies, vacant possession sold for $4.25 million. The result is interesting because the flexibility it offers to the buyer. Occupy separately, split and lease part of it, generate income from one portion while using the rest. In a market where buyers are cautious, optionality commands a premium. The fifth property is in Sloane Street, Marrickville. 635 square metres of land, 650 square metre brick building, E4 general industrial zoning, street and lane access, walking distance to railway station, and sold for $5.36 million with vacant possession. This is not a primary income story. It is a location story. The E4 zoning, the proximity to the station, in the west setting, a buyer has priced what this site could become over time, not just what it earns today. Last month I talked about Barrack Street sale in Sydney, 19 million hospitality site, where the real value was an 8:1 floor space ratio and a 16-metre height limit. The Marrickville result is a smaller scale version of the same principle. Always know your zoning. Let me spend a few minutes on the theme that runs through the Hamilton and Hurstville results, because it is the most common source of value that owners overlook when thinking about their exit. The lease. Not the building, not the location time, not the location alone. It's the lease. When a buyer's solicitor, accountant, and financial review a commercial investment property, they do not spend their time admiring the building. They read the lease cover to cover. And they look for four things. 1. Certainty of income. Is the rent clearly stated, properly documented, and supported by history of rent reviews being conducted in accordance with the lease terms? 2. Strength of the term. How long is left on the lease? Or options exist. A lease with 2 years remaining and no option means a buyer immediately has to factor in the vacancy risk, incentive costs, and reletting time. A lease with 7 years remaining and a 5-year option removes that question entirely. The difference in value on the same property can vary significantly. Third, the quality of the tenant. A national operator or a government agency is not the same proposition as a company with no track record, no personal guarantees. Buyers and their banks price tenant risk carefully. 4. Clarity of outgoings, gross or net lease. Are outgoings recoverable? Ambiguity creates friction in due diligence. Friction costs money. If you are 3 to 10 years from selling, you have something most vendors don't. Time. Time to get the lease right on your schedule, not under pressure of the sale. My strong advice, start with a conversation with an experienced commercial real estate and business advisor, someone who can review your leases with a buyer's eye. Identify the gaps and give your solicitor a clear brief to work from. Don't wait to discover the problems under due diligence. Next thing I want to talk about is the tourism research regarding tourism hospitality properties. Tourism Research released their June 2026 data recently, and the numbers are genuinely strong. Tourism spent in Australia, domestic and international combined, has reached $197.9 billion over the past 4 months, up 10% on year. International visitor arrivals reached 9.2 million, up 10%, while visitors from China up 20%, and Taiwan at 24%. And in New South Wales alone, specifically, domestic overnight spend increased to 1.9 billion, the largest increase in any state in the country. The forward forecasts from Tourist Research Australia project total spend continuing to grow. 207 billion in 2027, 2016 billion in 2020. In 2029. So if you have a pub, motel, boutique accommodation, caravan park, a coastal retreat, this is the environment you're operating in. Now, here is the question I get asked when the data looks like this. Is now the right time to sell? The answer is most likely yes. Depends on where you are in your own cycle. Not just where the market is up. Not just where the market is. A business that is growing strongly may be better served by continuing to trade and capturing another 2-3 years of earnings before going to market. The additional EBITDA presented clearly over 3 to 5 years may well be worth more than any premium a buoyant market adds to your price today. But if you're approaching the natural limits of what you can extract from the operation, whether that's your own energy, the property's capacity, or total market's length, or total market's depth, then selling now while conditions are supportive and buyer appetite is genuine is a very legitimate strategy. The 4 types of buyers in the active right now. 4 types of buyers are active right now in the hospitality space: the lifestyle investor, the experienced operator, the sea change buyer, and the ecotourism and experience-led buyer. An increasingly active category looking for something irreplaceable. Each of them wants something slightly different. Knowing which buyer your property is most likely to attract and positioning accordingly is one of the most important things you can do before you go to market. The last thing I want to cover today is one that comes up in almost every serious transitional conversation I have, and yet most owners have never properly investigated it. That is zoning. More specifically, the gap between what your property is worth based on its current income and what it could be worth if you understood what the planning framework actually allows. Last month, I talked about the Barrack Street sale, $19 million for a site that operates as a restaurant bar. The income does not justify that price. The 8-to-1 floor space ratio and 60-metre height limit do. This month, Marrickville tells the same story in a smaller scale. Across New South Wales right now, properties are being priced on their development potential as much as their current use, and the owners who benefit are the ones who understood what planning framework said about their site before they went to market. Here's what I suggest. Go to the planning portal. It's free. It is publicly accessible. Search your property address. Look for your zoning, your floor space ratio, your height limit, any applicable overlays. It takes 10 minutes. It can be done. If you've not done it recently, do it this week. Then look at what is happening around you. What have neighbouring properties been approved to develop? If a 6-story mixed-use building was recently approved 3 lots from yours, that tells you something about what the market and planning framework will support. And if you find something unexpected, a rezoning you are not aware of, or an FSR that has changed a transport-oriented development corridor that now includes your street, that conversation is worth having with someone who can translate that and what it means in your transition plan. Understanding your zoning before you go to market, not during the process, is the difference between capturing the value and leaving it behind. 3 rate rises in 5 months, then a pause. Tourism at record levels. Commercial property still transacting selectively but strongly in the right assets. The theme this month across all 5 sales and all 3 articles is the same. The owners who come out ahead, not necessarily the ones who timed the market perfectly. They're the ones who did the preparation work, who understood their lease, knew their zoning, had their financials in order, and could tell the story clearly to the right buyer. If any of what I've covered today raises a question worth exploring about your lease, your property zoning, or the timing of a hospitality exit, I'm always happy to have a conversation. No obligation. There's a link below to take the transition readiness test. It takes 5 minutes and will tell you where you stand. I'm Contasitas. It has been the July 2026 edition of the Transition Edge. Until next month.